Many thanks for your time. Just explain the big changes that were in this statement today, and really what do you think is motivating those changes from the Reserve Bank?
Well, there are two big bits of data we got over the last little while that have been really critical. One was the upside surprise we got to the inflation numbers for the fourth quarter, and the other was the sharp fall in the unemployment rate to the lowest level since 2008. And the RBA needed to absorb that information into how it was thinking. And the way it did that was it revised up its inflation forecast by a decent amount, I might add, so that now underlying inflation gets above the top of their target band in the next couple of quarters, in their view, at 3.25%. And it revised down its forecast for the unemployment rate. They think the unemployment rate will now fall, as you say, below 4%, and that's their central case. At the same time, the RBA is pretty keen to point out that they are still looking to be quite patient with their cash rate setting, because they still aren't completely convinced that inflation will be sustainably on target over the medium term. However, they did take a policy step, of course, which was widely expected. They ended their quantitative easing program. So they're gradually unwinding and unpacking the stimulus measures that were put in place to support the economy in the face of the pandemic. And the next question, of course, is when does the next cash rate rise come? It's certainly not going to be 24 like they had previously suggested late last year. It's going to be earlier than that. That seems fairly clear. But they're still not at all committal to what that will look like.
OK, so let's go to that very central point. In regards to the timing of any interest rate rise in Australia, it's not 2024. In your opinion, now analysing this data and what you can see out there, when do you anticipate the Reserve Bank will move?
Well, we certainly think that 23 is likely. We've got in mind that the first quarter at the beginning of 23 is our central case at the moment. But if you look at what's going on with inflation and the unemployment rate, and we've got to listen to see what Phil Lowe has to say tomorrow, the risk is that it could come a bit earlier than that. As I say, our central case is early next year. The main message, I think, that households and businesses need to start gearing up for is that, of course, these ultra-low interest rate settings are not going to stick around. At some point in time, the cash rate's going to rise, and it's going to be earlier than the RBA had previously indicated. The RBA late last year saying it was going to be 2024. It's going to be a fair bit earlier than that is very, very likely.
These changes in the forecast, now, I mean, everybody forecasts and everybody changes forecasts, but does this imply that the Reserve Bank has been wrong? It was wrong for 7 or 8 years in terms of its inflation forecast on the low side. Now it's starting to rise. Can we actually point the finger and say that these forecasts are not helping make certain that monetary policy is staying ahead of the curve and not falling behind the curve?
Oh, look, it's a tricky game, as you say. Forecasting is really tough, and the RBA did undershoot its target for a considerable period of time, and now it looks like inflation's rising. They're forecasting it's going to rise above the top of their target. I think you need to separate the forecasting from the forward guidance. I think the lesson from the forecasting is, well, we all have to forecast because we have to take views, but I think the lesson from the forward guidance is going to prove that actually it's very hard for a central bank to credibly give forward guidance, and actually it can do damage to credibility, of course, if that forward guidance is a long way off what actually ends up happening. And that's the thing that we're going to look back and say, I think when we look at this and say some of these elements were experimental. I mean, particularly last year, if you remember, we had that 3-year yield target, the April 24 bond, and the bond market really disagreed with the RBA, and the RBA had to back down from that. So I think that's going to be a big question about how much of the forward guidance that's been put in place, how much of it was useful and how much of it we can think of as less useful.
As an economist growing up and studying, and now as a practicing economist, could have you ever imagined Australia would have had an unemployment rate with a 3 in front of it?
Oh, well, we've had one before. You have to go back quite a long way, and you have to go back to the 60s to get there. But you know, it's certainly so history does repeat. We have actually gotten there before. We haven't gotten there in a long time though. So as the RBA pointed out in its statement today, and the governor has repeated many times, given we haven't been there in sort of the last few decades, it's hard to know exactly how the economy is going to respond if the unemployment rate does get down into the 3s. We have been there also on a state level. We've been down there at those sorts of levels in New South Wales and in Victoria in 2019, just prior to the pandemic. And you know, one of the interesting things there is, even with those low rates of unemployment in New South Wales and Victoria in 2019, we didn't get much of impetus for wages growth. So this is a thing the RBA is emphasising, that even that 19 episode, and certainly we haven't seen 3% national rates for a long, long time, there's still considerable uncertainty about how much wages pressure is going to be generated from where the labour market is at present.
Because that's something that the Reserve Bank today in its statement really does stress very significantly, that the key number now, while you might look at the inflation number, the real number that they're going to be watching is that wages inflation number. Now, 2.2% right now, but what they're really trying to see is if a tightening labour market is going to translate into higher wages. And if that's the case, that may be the catalyst for future rate rises.
That's certainly the way the RBA is framing their reaction function, as we describe in the economics community. They're saying, yes, inflation's lifted, yes, the unemployment rate's low, but we need to see it get through to sustain wages growth of sort of 3 to 4% is what the governor's been nominating before they're going to start stomping on it by taking back the support and lifting the cash rate. And so there's going to be a lot of emphasis on getting wages growth going more quickly before they start to lift the cash rate. I think that's what we're going to hear a lot more about when we hear from Governor Phil Lowe tomorrow when he gives a speech that follows up today's decision.
Okay, just one other aspect of this, because the labour markets in many areas are tightening. You know, we get it from small business. They can't get the workers. They're having to pay workers more. So there's anecdotal evidence that there is wages growth out there. I guess also this comes to when you start to see significant wages renegotiations. And as a result, when unions and employers start going together with rising petrol prices, with rising prices in the community, it almost seems inevitable that at some stage there is going to be a significant push for higher wages.
Well, this is what the RBA wants, needs to see. That's what they've described as a necessary condition for them to believe that inflation will sustainably be back on target. And as you rightly described, there are parts of the labour market where things are quite tight, particularly because the border's been closed, there's been a lack of availability of certain skills. But we've also got to keep in mind that almost 2/5 of wages in Australia are determined on enterprise bargaining agreements. These agreements tend to be on average about 3 years long. So, and they've been set at quite low rates. So it's going to take a while for the tightness in the labour market to feed through to those contracts and get renegotiated so that you get broad-based wage pressures and rates running at 3 to 4%. This is a lot of what the RBA has been talking about in terms of the gradual lift in wages that they're expecting, and therefore their more gradual and patient approach to setting the cash rate.
Okay, just one other aspect of this. Is there an argument that the Reserve Bank should be raising interest rates sooner rather than later in order to build at least a bank of ammunition in case the world economy, the global economy, has some sort of a shock into the future? In other words, so it's got some bullets to fire at the economy if indeed it needs to in the future. If they've already got the cash rate close to zero, there aren't too many bullets to fire except going perhaps back to printing money and unconventional monetary policy, as they call it.
That's certainly a reasonable argument, but you've got to keep in mind that it would be wrong to be doing that unless the economy allowed you to, because if they lifted rates and inflation hadn't got going sufficiently, then it could turn out that you actually squash the inflation that's there. And when the next downturn comes, you've actually got to cut even harder because you start off with quite low inflation in the scheme of things. So they can't go any faster than the economy allows them to go. But certainly, look, it's a good news story. I think that's what you're headed towards. It's a good news story that inflation is lifting a bit, that wages growth might get going, the economy's starting to heal and recover. And of course, a cash rate at 10 basis points is a long way from normal. A cash rate that's a bit higher is more like what we're used to, and it would give them room to be able to cut in future if another downturn and when another downturn arrives.